Scott Shang, I guess a couple years ago, and it's funny, we were talking about doing video, and he was telling me about the Find My Way Home Network, and it's a group of very experienced, high-level people, and I was like, this is exactly what I need to get on, educate more consumers, share some of the knowledge that we had, so we can share the wealth with everyone else. So here we are.
Absolutely. And a lot of that came out of Scott and I are here in California. We're only licensed in California. And you can't sort of put a geo fence around a website and answer questions only for Californians. So it does end up spreading around the country. And we got a lot of questions. And so through the timeline, through the 10, 12, 15 years, we've had people just like yourself join us on this journey. Expert loan officers who've been in the business a long time. They're focused on helping consumers. Now, our other guest here is Jim Duffy with Alcova Mortgage in Charleston, South Carolina. Just before we came on, I didn't realize Jim was in Charleston. Charleston is home of my favorite barbecue place on the planet. And I may not be able to concentrate about mortgages tonight. I may just think about going back to Lewis Barbecue.
There is something to be said for Charleston as the culinary capital, possibly of the nation, I will say. And Lewis Barbecue is awesome.
Well, that's what I understand. We were looking at places to eat, and I just get fixated on barbecue, but there's a lot of really good food in Charleston, right?
Oh, man, we can never exhaust it. I mean, we've been to so many restaurants here, and we haven't hit them all. Not even close. It's awesome.
All right. I'm coming back. So aside from food and barbecue, tell us a little bit about yourself, your practice, how you got into the business, and how you came to be a Find My Way Home expert.
Yeah, I'd be happy to. Josh, Jason, good to join you this evening. Or this afternoon, depending on where you are in the country. And yeah, so you mentioned, I think, Jason, you mentioned 2008 and whatnot, and Josh, and that's where Scott got online and you, Josh, got online and started Find My Way Home. Well, Scott and I were together at the time because we had a little private Facebook group where we all shared a lot of best practices at the time and all figuring out, hey, all our realtors just left the business. What are we going to do? And so Scott went online and a bunch of us tried different things and have been friends ever since. And it's been great because Find My Way Home really rose to the top of all the efforts that all of us had at the time as the number one thing, I think, to really educate and answer questions and dive deep into what can really help the homeowner, the home buyer, to understand the questions and really grasp what they're doing. And I guess the key is to feel confident about the home buying process.
And that right there, Jim's a great kickoff to tonight's conversation. We're going to answer one of, if not the most frequently asked questions in mortgage when someone actually gets into the process. If you're thinking about buying a home, you're probably not on this path, but once you get into the process, you've met with one of us, you start going, underwriting. He keeps talking about underwriting. What is underwriting and what does it mean? So start with a super basic definition of it. It's the process that the lender uses to take an in-depth look at your file to ensure that it meets the guidelines of the loan program that you're qualifying for. So essentially, it's a person sitting there examining all the paperwork that we gather and collect and confirming that you do actually qualify for the loan. So that's a super simple, brief description. We're going to go much more into greater detail on that. Jason, why don't you, before we get to that, how do we get to underwriting? So when we're ready to go into underwriting, before we tell people, what have you done with and for a client before we even get to underwriting?
I was going to add, Josh, so I think it's one of my first bosses told me, I was like, who's this underwriter? And we'll explain this today, but he said, basically, we can't let the inmates run the asylum, right? So we all are salespeople, and we want to sign off on everything. So for any customers out there thinking, why are they being so hard? We'd love to clear it, but the underwriter obviously clears it on behalf of the company, the ones putting up the money. So before we've gotten to the underwriting process, typically the client has given documentation and paperwork that their upfront salesperson thought they might need. They either did their due diligence or they didn't. They either missed something or they're very thorough and they got it all. So a lot of that we think they're pre-approved, and sometimes, in fact, they actually haven't because the underwriter hasn't gotten there yet. Did that answer the question, John?
Absolutely. So if you've gone through the process before, you know what folks like us ask for. We want to see your income documentation. We want to see your assets, banking, retirement accounts, investment accounts. We're going to want to see a credit report, which we're going to pull on our end. But basically, all of that first-party documentation that comes from you guys, third-party documentation like appraisals, preliminary title reports, it all goes into that file that tells a story. I keep saying it like it's a file like this. That tells you I've done it too long, because now it's zeros and ones in a computer. No one actually has paper files sitting on their desks anymore, but we still think of them that way. So when we think in terms of an underwriter, what do? They review the file to confirm that it meets the guidelines. There's four main things they're looking at. We're going to jump into detail on that. They're looking at your credit. They're looking at your capacity to repay, which is primarily your income. They're looking at your capital or your cash, the money that you have for your down payment and your closing costs. And they're looking at the house that is the collateral. Jim, why don't we start? Credit's a big one. It's an easy one because everyone's getting, their credit card statement or Credit Karma. They kind of have an idea of what it is. But when the underwriter jumps into a file and they're reviewing credit, what's an underwriter looking at?
Yeah, that's a good question. So the credit report is the basis of it, but the credit report tells a story, right? First of all, if I can take one step back, think of an underwriter. For anyone who's looking to buy a home and says, well, I've heard underwriters ask for way too much stuff, and imagine you're Josh and you're wearing Lewis's barbecue hat on this side with the brim coming out, but if you turned it around, it's got Rodney Scott barbecue on the back, right? Because an underwriter really wears two hats. And one is they want to approve your home loan and get you into the home that you want to get into. Then they turn it around. And the other hat is they want to protect the company and make sure that that file, that hard file or digital file, meets the criteria of who we're going to sell that loan to, whether it be Fannie Mae, Freddie Mac, FHA, VA, whatever, or insure the loan by. So with credit, and I think the two hats is important because if the home buyer understands that, it kind of sheds light on, they're not just nitpicking me, they're making sure that the company is okay and we can sell this loan. So I hope that helps put a context to it at least. With credit, it's just a credit report, right? It tells the story. So the story is you've had debt before, you've taken on debt before with a promise to repay it. How's that going? And I think that's the easiest way to think about it. If there's a lot of late pays or slow pays, well, it's a red flag at least. It doesn't mean you won't be approved, but it's a red flag to be looked at. And if there's a lot of collections, it means for whatever reason, you didn't pay some debt, right? A potential buyer didn't pay some debt that was obligated. Now, why? And that is the reason. And then sometimes there's bigger issues, more serious issues like a bankruptcy, a foreclosure, a deed in lieu, something like that, right? And the underwriter really has to look at that. What was the cause? What caused that? Because what the underwriter is looking for is not you were a bad person. No. Those things happen to so many people. All of us have seen all of that so many times. And the key is it going to happen in the future, right? Did you lose your job? Was it a divorce? Was it all these reasons exist why credit takes a hit and a bump? And the underwriter wants to make sure, are we past that? So I think that's really what credit is all about. It's the credit report, but it goes deeper than that. It's going forward, what's it look like?
I was going to say, Josh, too, I think it's super important. We get calls a lot, and that doesn't always disqualify you, but generally most lenders have a credit score requirement. And I don't think we're going into detail to that. We all kind of accept our risk and what we want to lend to as a bank or as a lender. But we'll get the clients a call and say, well, I pay cash for everything. And it doesn't mean just because you don't have a credit score, you won't qualify. But for most banks, they want to see credit history to at least determine what's your ability to pay it back.
Well, no, I think you bring up a really important point in terms of credit scores. And without going into, because every loan program has its own credit score requirements, minimum credit score requirements, but those can even vary by lender. Lenders can have their own overlays, and that's one of the things that the underwriter is looking at. Do you meet the credit score criteria? But what I like to tell people, I started doing this in 1996. I was one of the last people into the business where we still had to manually underwrite every file. There was no automated underwriting. We didn't even have credit scores on the credit reports at that time. Credit scores and automated underwriting sort of came in together at the same time. And I'll say that anyone that came after 2000, there's a sort of a blind spot that those loan originators can have, in that they collect all the information, they make sure it looks right on the screen, they see the credit score meets the requirement, they push a button, they send it to the automated underwrite, and it comes back and it gives them an approval. That doesn't mean that the underwriter is going to look at that credit report and still say it's okay. There's a million things that can be hiding and lurking in that credit report. So before we move on past credit, do either one of you guys kind of want to jump into some of the things that may be on a credit report? And again, it's probably helpful to explain what a credit report is. It's data in a file that is read by the automated underwriting system. 90% plus of loans today go through an automated underwriting system before going to the actual underwriter for validation. And a lot of times what that automated underwrite is doing, it's not picking up all of the data. One of the big ones that we have, so as an example for you guys, and I'm sure you have some examples to add on top of this, when we had the foreclosure crisis, a lot of people would have had a bankruptcy in there as well. So you could have had a bankruptcy, they stop reporting on the mortgage, and then the mortgage goes to foreclosure. Credit score can't see it because the foreclosure never showed on the credit report because it stopped reporting. Score looks okay, it goes through the automated underwriting. Underwriters with their microscope are going to dig into that and see that. So it's important, all the things that Jim talked about. They're looking at, how have you paid people back? What do you owe? What do you owe relative to your current limits? Most of that is picked up by the automated underwriting system, but our intrepid underwriter is still going to go through that thing line by line and make sure there's nothing else hiding in there that would disqualify you from being eligible. Before we move on from that, anything you guys wanted to add to credit and what you're looking for when you're helping a client?
Yeah, I'll jump in first. That's a very good point, because it brings up two things. One is, some people are fearful because they've got some blemishes on credit. I would suggest don't be, but other people want to kind of hide something and sweep it under the rug, like, we'll never figure it out. Look, we'll figure it out. Better to talk about it up front. Just bring it up, right? Whatever it is. And the big example is where a foreclosure does not show up on credit report. Guess where it's going to show up? On title. When you're going to buy a home, we're going to pull title on that home, and everything else shows up title-wise that you've ever experienced. So it's best just to bring those things up, because if we know them right up front, we know how. Look, we're very experienced. You've been in the business, what, 20, more than 25 years. Jason's been in the business a long time. I've been in the business 20 years. We're not the guy who on the commercial, whatever mortgage company's on that latest commercial when you're watching golf or football, in the cubicle, who just got there in the last year and probably will be first out, laid off as they lay off. We've been at it a long, long time. So we know how to structure loans and make them work if we know the whole picture. So that would be my 2 cents to add.
I would say, Josh, that probably one of the, we created a checklist for loan officers, because I'm like, okay, what are the top things that loan officers make mistakes at, especially if they're new, like Jim said. And one of the things that I continue to see as a problem is disputes. And so you'll have these credit companies and credit repair restoration say, hey, we'll just dispute that account, and it has a bearing on the credit score. Takes it out of the calculation. We won't go too far into that detail, but depending on which loan program we're going with, you have to remove the dispute. And if a loan officer, when they gave that pre-qualification letter up front before the underwriter gets it, didn't catch that, it could be a serious problem. The next biggest thing I would add is if you're serious about buying a house, have the lender pull your credit report. Again, another very complicated topic, but there's different credit score models out there. And the ones that most of the lenders use is the one that's a little more stringent, a little more strict. I see myself probably 20 to 30 points lower than what the consumer monitoring type of source brings in. So I don't know if you guys see a different opinion about that.
Well,
Yeah,
the worst part about it is it's more overstated for the lower credit scores. If someone tells me, hey, my Credit Karma says I'm an 800, they're going to be pretty darn close to an 800. If they tell you, hey, I've been working on it, I just got it up over a 680, like, I hate to tell you, that thing ain't going to be over a 680. And you guys are probably seeing the same thing. So you want to work with someone experienced and knowledgeable that's seen a lot of credit reports, can help you with that. Jim, one thing that you said that I want to add on to, and it's really just a different variation of exactly what you said. The way I see our job is as an editor. You need to tell us your entire story. And we want to edit that story as pretty as possible so that when the underwriter gets it, they're reading this beautiful story and they go, I love this. I want to be part of this.
And
Rubber
we've all
stamp,
done
you are
that.
approved.
100%. We have all done that. And a good loan originator knows how to do that, how to present that story to the underwriter so it has the best chance of approval. I love that. That's great.
But you can only do it if you know the whole story. If someone gives you bits and pieces, the underwriter is going to start pulling it. Well, this story doesn't quite make sense, and they start pulling at straws, and the whole thing unravels. So when we're thinking in terms of underwriting, don't think in terms of I need to hide things. You need to be working with your originator to disclose everything. Our job is to get you a loan. That doesn't mean to do wrong, fraudulent things and hide things, but there are ways to package and structure and tell your story in the best possible way so that an underwriter sees you as an acceptable credit risk and meeting the guidelines. So with that in mind, let's jump on to mortgage loan approval factor number 2, which is capacity. Capacity, a fancy way of saying your income or your cash flow available to repay the loan. Jason, Jim, either way, do you want to jump in? And it's a big topic. I mean, in terms of all of the potential income sources, what is an underwriter looking at when they're measuring your ability to repay the loan?
Jason, why don't you go first? I'll jump in after.
Thanks, Jim. So capacity really is looked at in 2 ways. The overall debt to income ratio is the most important, I think. But we do look at the overall, what we call, here's how much I make a month and here's how much my debts are. The beautiful news is we get to use gross pre-tax money. But what we'll do is add up the minimum payments on credit cards. And another thing the underwriter is looking for is auto loans. There's a lot of things that are not included in that. We could go on a long list, but what is it? Car insurance, telephone bills. There's some things that we just don't consider. This is why you need a good professional on your side to say, okay, how much do I make a month? And really, when you get all those questions of how's your income broken down, and it almost sounds like the loan officers, the good ones, are investigating, like, hey, what have you done for the last 2 years or 1 year? We're really trying to figure out if it's an acceptable source of income to see if the underwriter and the loan programs will accept it as an acceptable source for that capacity ratio. And another piece we'll look at is what we call the front end ratio, which is your housing only compared to your gross income. And then, of course, like I said at first, the total, what we call debt to income ratio. So that falls in capacity.
That's one of the big differences. Back in the 90s, you had your paper guidelines and you'd open up the book and say your front end ratio, your housing to income ratio has to be this. And then you obviously have other debts. And so your total debt to income ratio can be a little bit higher. For Fannie Freddie loans, most of the time a double ratio, meaning just one total debt to income ratio is okay. FHA has a 47% front end and 57% back end as a max with an automated underwrite. So these things move around a lot, but really what we're looking at is going back to the credit report and saying, what are the debts that we have? What are our proposed debts with the new home that you're buying, including taxes, insurance, any mortgage insurance, any HOA dues, anything and everything. And they're really going to dig into your income. Jim, one of the things that I get so often is borrower provides all their stuff. We get the file ready to go. We send disclosures out and they go, hey, I can't sign this. I make a lot more money than that.
Right.
Can you explain
Yes.
some of the differences in how an underwriter is going to calculate your income versus what you think you make today this month?
Yeah, I can. So the way I normally put it is there's there's really two types of income, and it's very easy to distinguish if you just think of this. One is stable income from today going forward, and the other is unstable income, and there you have to look backward. So when you look forward, the other look backward. And where you look forward is where your income is consistent. Like if you're on a salary, you make $60,000 a year, you know you're going to make $60,000 a year next month and the month after that, the month after that, so long as you don't lose your job. Or if you're hourly, you make $22 an hour and you work 40 hours a week, right? We know exactly what your income, your base income, you may have overtime, but we know exactly what your income is. $22 an hour times 40 hours a week. That's it. That's your income going forward. The problem comes when the income, there's two other distinguishing things, but the main one is when income you have to look backward. And that is if someone's self-employed, right? The three of us know this well. We're considered self-employed because our income varies, because we're on commission, right? And so our income varies every single month. So we have no idea what our income, an underwriter has no idea what our income is going to be 6 months from now. The only thing an underwriter can do is look backward and say, well, you're self-employed. Let's look back 2 years, see what you made the last 2 years per tax returns, for example. And and divide by 24. And that's a reasonable average income that we can use going forward, assuming everything else is stable. So that's the biggest one I get. And part of that, and I'll just have a tangent here, is with so many people these days, they're working 2 jobs, right? You have a full-time job and you're an Uber driver, or a full-time job and you started a business or whatever. That's perfectly fine too, but there a 2-year history does come into play. So many people think they have to be on the job for 2 years. Absolutely not true. You can be starting a job in 2 months and still be approved today for a home loan. And we do that a lot because it's stable income at the time that it starts. But if it's not, or if it's, you have to show a stability of unstable income. And I know that's a contradiction, it sounds like, but the best way to do that is to average going backward, take the average and say, that's about the average. That's what we can count on going forward.
So kind of to recap, the first 2 factors here of underwriting that we've talked about are the most important. They're going to look at your credit, and not just the credit history, also the debts. And that's where we start to be able to now look at capacity, your income, and calculating a debt to income ratio. So when most people think in terms of, am I going to qualify for a mortgage? Those are the 2 big things they're thinking about. But we also get a lot of questions in terms of capital or your cash that you have available for your down payment and your closing costs. Jason, what are the big questions that you're getting, or what is an underwriter looking at in terms of someone's bank statements and their available funds that could be problematic, that we often get questions from borrowers about? Is this going to be okay? Can I do this? What about that?
Yeah. So I think a lot of us hear this all the time is, oh, I need 20% down. And so kind of to go in a little more detail of your question, it really depends on the loan program. And literally what the underwriter wants to see is, okay, where's the funds? Are they acceptable funds for underwriting? Depending on the product and the loan type, you can need 1 month bank statements, 2. No screenshots, please. Right? That's
the eternal pain. Yeah.
We should make a show just about no screenshots, no JPEGs, no screenshots. Anything from your phone is not going to be okay if it's exceptionally blurry,
crumpled
and
up
tiny.
and stuffed in the couch in a picture. No.
Yeah.
So the underwriter wants acceptable documentation, and usually for acceptable documentation, depending on how many months of statements that is, and then we need all pages. It makes it an official document. That's what the underwriters want. I promise we're not being complicated, but it has to be all pages. If it's a retirement account, we need to see what are the terms of withdrawal, and then determining how much money you actually need just depends on the down payment percentage. We do quite a bit of down payment assistance in my area. So that will cover some, but we still need extra money for reserves to see, okay, once you close on the house, if you're not going with the 3.5%, 5% down minimum programs, which are your standard ones, usually there's a reserve requirement, meaning after you come to closing with X amount of money, how much do you have left over to support your payments and expenses going forward? So it's generally not acceptable to clear your bank completely. There are rare occasions, but the bank statements and what kind of statements, quarterly, monthly, it just depends on the loan product.
Jim, you have anything to add on that one?
Yeah, a little bit. That's absolutely true. And the statement thing is the bane of our existence. Get the full bank statement. It's just funny between us because we've all experienced it millions of thousands of times. The main thing with assets is we have to do one of two things. We have to be able to show they've been in your account for usually 2 months plus, and that is called, in our speak, seasoned. Every industry has its terminology, right? Those are seasoned funds. In other words, they're your funds. They've been in your account 2 months. No one else is after them. So we're going to assume they're just your funds, right? They weren't. The other is sourced, right? So lots of people have to source funds. Let's say you sell something to qualify to get the money for your down payment, right? Let's say you sell a boat or a car or something. Well, we have to source that with some documentation. And sourcing just means documenting where it come from. Maybe it's a tax refund, easy to source, right? There's a document for that. And other times it's gift funds, right? Mom, dad, grandma, grandpa want to help you buy a home because they know that that's an asset that will help build your wealth. It'll really become the foundation of building wealth. So a lot of times family really, really want to help you get into your first home and they give you a gift. Well, that's great. We just source the funds. Usually it's 1 month's bank statement from the donor. And that's the big question. The donor's always like, why do I have to give my statement? I'm not on the loan. It's to prove that you have the capacity to give the gift, right? On conventional loans, we don't need a donor statement, but on FHA, we still do. It's just capacity, and it's sourcing the funds, sourcing the gift, right? And so that's the biggest question that I get. And the biggest thing that I come up with against, because I don't know about you guys, I speak Spanish, so I do a lot of, and different cultures have different ways of managing money, right? A lot of times Hispanics, because of home country issues with banks and things, they don't want to put their money in the bank. It's buried in a tin can in the backyard or somewhere. I don't know. And so that's where you can't source it. So you have to season it. Cash, you can't source. So we have to season those funds. So you have got to put them in a bank, leave them there for 2 months, and then go forward with the home purchase.
That's perfect.
And
Jim.
one of the things there, Jim, the question behind the question, that several things. When you said when you have to source funds, if there's a large deposit that shows up, or that gift that shows up, the reason we have to show the donor's ability to gift, the underwriter's big worry or concern there is that you borrowed the money somewhere. Yep. And if you borrowed it, there's a payment, and we don't have that payment included in the debt to income ratio. So they're not trying to be an investigator and say that you're lying. It's just they want to have their ducks in a row and make sure that there's not any undisclosed debt out there. So when we're looking at assets, we want to make sure it's been in your account for 2 months, and in which case we wouldn't have any of these large deposits. If we have large deposits, we want to have logical explanations of where the money came from, that those are acceptable funds.
And that's it. Just really, it's just proving that you don't owe more money. It's not a new debt that you took on to buy this house, because you're absolutely right.
Yeah, I think Josh, I just did a video about this. We're really not telling you how to spend your money and how to move your money around, but for underwriting purposes, before you make any transactions or transfers or large deposits, cash deposits, talk to your lender, talk to the expert, figure out if it's going to be acceptable for underwriting, because that underwriter is going to see it on the full statement. Where did this money come from? Generally, if it's outside of payroll, ask your lender.
Absolutely. And I don't know about you guys, but most of the time, I had a conversation with a client this morning. We spent 10, 15 minutes. Well, I have this money. It's coming from here, and we're going to put it here. Is that a problem? None of it was a problem. It was all okay, but he was asking. But it's the 1 out of 10, or probably more like 1 out of 20 client that thinks nothing's a problem and is just firing money around willy-nilly. And I don't know about you guys. I don't know that I've ever had a deal fall apart because we couldn't source funds. You can unwind it, but it can be a long paper trail and be a little unpleasant to have to do that.
That's the problem with moving funds. That's why I always recommend people. That's why, for example, when I know someone's getting a gift from grandma to help buy this home, I think that's absolutely awesome. And I tell them, don't let grandma put that in your bank account. Grandma should wire those funds directly to the title company or closing attorney the day before closing. Don't ever put it in your account, because that just means more paperwork. We have to show that it left her account, it went in your account, it's now the balance. Let's make it simple. So to your point, Josh, we're part of what we're trying to do is make it simple and reduce the paperwork, believe it or not. And we can in a lot of cases. If we just follow the lead and talk about it, we can reduce the paperwork and the headache a lot.
I could have missed this. One last thing I was going to add is, we have some clients that are like, well, I have $100,000 in the bank account, hypothetically. Why do you care where it's at, where it came from? Well, you could have borrowed the money. That's not me saying that. That's what the underwriter's thinking. And if you possibly borrowed it, do we need to count another debt against your capacity, your debt to income ratio? So there's really a reason for all of this. So I'm glad we're going into this today.
So the last aspect, and by all means, we're covering the 4 major elements of underwriting to give you a broad overview of what an underwriter does, what they're looking for, and why you have no reason to fear it. But every file is unique, and there's lots of little details. There's no way in a 45-minute video we can cover all of that. But the last big section is the collateral. What do we mean by the collateral? The property. So we've got 3 main things an underwriter is going to review to determine whether the property is okay. We've got the appraisal, we've got the preliminary title report that's going to tell us some things about the property. And in you guys' neck of the woods, we don't really see these in California, but I think in both of you guys' markets, surveys are fairly common. Anything else that you guys see under collateral that underwriters are needing and reviewing in your files?
Go ahead, Jim.
Yeah, okay, I'll jump in. I mean, that's the bulk of it, right? And then obviously it depends on the collateral at that point, right? So a lot of times there's almost always an appraisal. An appraiser goes out and assures that this collateral is worth let's say it's a $500,000 loan amount, right? This collateral is worth the $500,000. So the lender is not putting themselves at risk. If for some reason the buyer couldn't make those payments for whatever reason, the collateral would cover that, right? And that's what the lender is trying to do. And then there's a few things that, and sometimes that requires the collateral is good if and only if it's safe as well. So sometimes the appraiser will make note of repairs for health and safety issues, right? But then there's a few other things. If the property is on septic or well.
Swell.
It's just swell. You're just all happy today. If it's on septic or well, a lot of times we'll need a septic inspection. Sometimes we will, sometimes not, or a well inspection to make sure the water is potable water and it's healthy. And it's like, if there's a private road, this doesn't happen very often, but it does happen. We have to make sure that all the neighbors that come and go on that road have a road maintenance agreement together, things like that. There's things that do come up with the collateral that it just depends on the property and the type of property and where it is. Yeah. I hope that helps.
I think usually, generally speaking, most of the lenders out there in traditional residential lending, like most of us do, they don't want commercial. They're looking at, is this a commercial use loan or is it a residential use loan? And then one of the other things that I kind of warn our clients about is you don't want the biggest house in the neighborhood, because guess what? When the appraiser goes out, like Jim was saying, to appraise the house, the underwriter, when they look at the appraisal report, they're saying nothing in this neighborhood is sold anywhere near this price or this sized house, and they have nothing to compare it to. And at the end of the day, we as the lender or the lenders we're delivering or selling to, they don't want the house back. And that's kind of, we'll get into this maybe a little in a minute, but really it's someone says, well, I have great cash or I have great collateral, but really at least these 4 items we're talking about today, we're looking at all of them. And if you don't have one, sometimes that can disqualify you.
So I know in Texas, the survey is a big deal for you guys. You want to go into a survey, what it is and why an underwriter would care about it?
So the survey, I always try to think of the easiest way to explain something. So I usually say the bird's eye view of the property and where everything lies on the property. Are there utility easements on the edge that says, hey, you can't build anything permanent on 5 feet of the property? And is the house actually on your property and not the neighbor's? So generally speaking, the survey is the bird's eye view from the sky down to see where all the permanent structures lie and that it is on the actual property.
Perfect. And going back to one of the things that Jim said, the appraiser is not a home inspector. but they are looking at the property. FHA requires kind of a mini inspection. They have to look at a few things, but they are looking around to make sure there's no health and safety items. And if there's something that looks out of whack, they may call for a further inspection. Your underwriter is generally not looking at home inspections. The home inspection is for you as a buyer to negotiate with the seller. But let's say an appraiser goes out and they look and they go, huh, that roof looks completely roached. And then they go in the house and they're like, huh, there's lots of stains in the ceiling. They're not qualified to say this roof is done, but they are qualified to say we need a roof cert. So it can cause additional issues. They may go out and they see a rotted wood and they may go, it looks like we have some wood destroying pests here and require a pest inspection and possibly a pest clearance, whereas it's not necessarily required in the contract. So a number of things that your underwriter is looking for, leading back to exactly what Jim said. They want to make sure the property is of enough value to secure the loan that they're making. In the event that they take that property back, that they're not going to incur a loss because the home is worth less than their loan, including any deferred maintenance, any things that would need to be done to bring it up to speed to sell it, sort of in their worst case. So with that, we've got a pretty good, big, broad overview of what your underwriter is looking at, what they're going through, what documents they're looking at and reviewing. One of the big questions that I see, I'm in a couple of groups where we answer questions for veterans, and they always say, hey, we've been in underwriting for 10 days. Is that normal? How long does it take? What should a borrower expect in terms of a turn time to get their loan underwritten?
I can jump in first if you like. It's up to you. Look, it depends a little on the lender, right? For example, we underwrite up front. A lot of companies don't. So it just depends on how the flow of your loan goes with the particular lender that you're working with. And what I mean is, I take the loan application, we structure the loan and say, whatever it is, it's going to be conventional with 3% down payment, etc. And get the necessary paperwork, income and asset docs and whatever. And then it goes directly to my underwriter for me. And the underwriter approves the loan subject to appraisal, title, stuff we don't have yet, can't get at that point, but it's being worked on, appraisal, title, homeowner's insurance, stuff like that, right? Now, other lenders work the opposite, and there's no right or wrong way. Everyone just has their own workflow. And others get everything together just perfectly, right? They get the title, they get the appraisal, they get all your documentation, whatever, and then present it with a little bow on it to the underwriter, who should just have one look, a really quick approval at that point, but that's much later in the process. So I think, Josh, your question is, I get it that we get that question a lot, but it really depends on the workflow of the particular lender that you're working with. I think that helps.
And maybe let's look at it from a different angle. I have a couple of friends that are underwriters, and I always like to know, and this varies. And if we go back to the middle of COVID, when rates dropped to the floor and every loan officer, underwriter, person under the sun was buried, you were talking some places were 30 days in underwriting, and an underwriter was getting 8 or 10 new files a day. But in a normal market, most of my underwriter friends say they're assigned about 3 files a day. So they go, so 8-9 hour workday, they spend 3 hours in a file. They probably spend a little less than that. It's about an hour and a half, 2 hours reviewing your file. But the thing you got to remember is kind of like Jim said, they underwrite on the front end, and then additional documentation comes in and that gets reviewed. And there's still a few conditions and those things come in and they get reviewed. So from our end, one of the things that we as lenders are measured on in terms of our quality internally, or for a broker to our lender partners, is how many touches does a file take? So in answering how long it should take in a normal market like today, my fastest lender will get us same day approvals. Worst lender is 4 or 5 days, but that's a fairly normal market. Again, going back during COVID, it was not uncommon that it was 30 days from the time it gets submitted to
Everyone
underwriting
gets slammed
to
when
getting
rates
that
fell that
approval.
much. Yeah.
Yeah, so it varies by market, but if we have a normal market where there's a volume of business, I mean, there's been times where there's so little business that everyone's got same day underwrites. But in a normal market, anywhere from 1 to
It
4
might be
days.
us if rates go to 7%.
Yeah, exactly. Well,
Yeah, that's what I was going to say, Josh. I think 2 to 4 days for initial underwritings, and 1 to 2 days for what we call resubs, where it's going back in for the second time or third time, depending on how you structure your business.
And I think the genesis of that question when we get asked is someone's like, well, they told us they submitted my loan to underwriting 10 days ago. We haven't heard anything back. Like, okay, that's probably excessive in the current market, not in every market, but in the current market, within a week, within 7 days of when you've been told your file's gone to underwriting, you should have an answer back. Another one, big common crazy misconception. Jason, why don't you tell us, so now my loan's approved, now I'm good, right? They're not going to look at my employment or look at my credit or look at anything again. They've already underwritten my file, right?
So don't go buy the furniture yet, right? so depending, so no, everything is not right. It's funny. I have a pretty big team, and I still went in today to look at an approval because I knew it was a very complicated loan. Sometimes the underwriter will say, "You're approved, but we want these conditions," and depending on who's working that loan, that condition, that item, that stipulation could be obtainable or not. And we really need to try to address that if you're good up front. And no, it's not done, Josh. They're going to look at the credit again. In most situations, a lot of situations, they're going to we pull a soft check to see if you've taken out new debt before closing. Don't move
Jason,
money around.
I didn't want to interrupt you on that, but it's an important point. I don't want anyone panicking, going, "Oh my God, they're going to keep pulling my credit." It's undisclosed debt monitoring. It's soft monitoring where it's looking to see, have you taken out additional debt? They're not literally pulling new hard pull credit reports. So I didn't mean to interrupt you on that.
No, you're good. Yeah, so it's not done yet. So don't start moving money around. The processors usually in our structure, the processor. We're not even talking about processors today, but I kind of call them the pre-underwriter. They're trying to set everything up for the underwriter to clear. They're working on some items the underwriter might need. We're working with the borrowers on some items we might need from the borrowers to get that loan, what we call cleared for closing. So no, don't make any drastic moves yet. It's not done until we get the clear to close. Just hold your breath, hang tight until your professional gets you to the finish line and you hear that clear to close.
I've got one that's even crazier. We had in January lady who said she was in an abusive relationship. She had a protective order against her husband. She had to buy a house. Went way out in the sticks. Realtor found a home in a price range that I didn't think we could find low enough in California to even buy. We look at it, it's going to meet the minimum property requirements. We can get it done. We get her loan approval, and about 2 days later, we find out she quit her job. Well, my loan was approved. Like, well, your loan was approved based off of you having a job. So any of that, your employment is going to be re-verified at closing. Your credit is going to be monitored through closing. Depending on how you move money around, it can cause a problem for documentation. So the loan approval is letting you know, cool, everything looks good, but don't upset the apple cart between there and closing. Jim, another thought with that. So cool, now they have all my stuff. How long is my documentation good for? Is it likely to expire? Is my underwriter going to be asking me for updated stuff throughout the process?
Generally, no. If you're under contract, it means, I mean, every state has their different things, but if you're under contract, it means you're probably closing within 30 days, contract to close, most of the time, maybe 60, right? But somewhere in there. So no, generally speaking, most of it doesn't expire. Your credit report is good for 4 months. So if we pre-approved you and it took you 3 months to find a home, well, we might have to pull a new credit report because it might expire before closing, right? But we're going to talk about that as soon as you get the contract generally, and we know what we need. Same with bank statements. If we got your bank statement 3 months ago when you started looking for a home, and now you're under contract 3 months later, sure, we're going to have to update asset documentation, stuff like that. But once we're under contract, very shortly after that, we should be fine and not have to really update any major things, except to your point, Josh, please don't quit your job in the meantime.
Don't quit your job.
And
And the updating documentation is more common. That if we've pre-approved you and it's a tough market, you may not get a house in 2 weeks. You might not get it in 6 weeks. It might be 12 weeks. We're going to need updated pay stubs, some updated bank statements. But generally, when you're in underwriting, you're getting pretty close to closing. And for the most part, you won't need to update stuff. Here's a really important topic. I don't want to go down a rabbit hole, but I do want to kind of talk about is people hear about automated underwriting. So Jason, you've pre-approved someone, you got all their documentation. You said, hey, good news, I have an approval through the automated underwriting system. What is the difference between automated underwriting and the underwriting that we're talking about today, and why does it matter to a borrower?
So I'm trying to think of the politically correct way to put this. Crap in, crap out.
Yes.
Okay. So I actually had a realtor partner in our area that said, hey, one of your competitors, that she gives pre-qualifications in 10 minutes, he or she, right? We'll just say that. And I'm like, well, it's not legitimate. Like, you didn't get all the documentation that an underwriter wants to review. We basically took when you run an automated approval, Josh, what you're doing is you're just taking the data that the client tells you, and the credit, the capacity, the capital and collateral, and we run it through, and whatever you enter into the system is what the automated approval system picks up, and it says, well, if all of this is valid, you have an approval. But it's up to reviewing all of those items like an underwriter to really determine, is it really approved? And you have to get the documentation up front.
It's helpful to understand that when we get an automated approval, it's a preliminary approval. It literally says preliminary on it. We have to release it to the underwriter. The underwriter reviews all those 4 elements we talked about, change the application to what they think the income is, what the payment is, what the debts are, then they rerun it and it comes out. So the garbage the loan officer may or may not have put in gets cleaned by the underwriter, and we get an end result that is totally validated. So the automated underwriting is used throughout the process. And again, if you have a good loan officer, experienced, anyone like these 3 gentlemen here have been doing this 20 plus years and know what they're doing, and they're not putting garbage in, it should be valid. We should never have a problem at the end where it doesn't match up.
That's a really good point. If I can jump in just for a second, a good loan originator, the 3 of us, really is a pre-underwriter, because we don't want to waste your time. We don't want to waste our time. And we'll guide you. If we know your loan can't be approved right now, we'll always put an end to underwriting if you request, right? We always can and will. But we'll also guide you of, if not now, when, and what do you have to do to get there? The other side of that coin, though, is, to your point, Josh, the underwriter, and Jason's point, the underwriter is not a machine. That automated underwriting is a thing that Fannie Mae and Freddie Mac came up with in early 2000s, I believe, or late 90s. The underwriter is a person. And guess what? The guidelines, I printed out VA guidelines a couple of years ago, and I went through them line by line by line and highlighted. They're about that thick, double-sided if you print them. There's a lot there. And the same with FHA, and the same with conventional, and the same with USDA, and all the loan types. My point being, sometimes underwriters make a mistake, but that's where a good loan originator, if you're working with someone experienced with relationships in the business, we know our underwriters, and our underwriters know us, and we have a great banter type relationship. Sometimes I make mistakes and my underwriter corrects me, and I've had my underwriter make mistakes and I correct he or she, and we just work together because everyone recognizes we're human. We're capable of making mistakes, and sometimes we do, but we work as a team to get that loan done as well as possible. And I think that's the key, is the underwriter is just a real person who has your best interest at heart, but also has the company's best interest at heart, and meshes the two pretty well.
Let's talk about something here that doesn't happen all that often, but you have a client who meets the guidelines, but the loan does not pass automated approval. Is there a way to work it through underwriting without an automated approval? And if so, when can that be an option? Jason, you want to jump on that one?
Absolutely. So we call it a manual underwrite. The automated system, it just picking up discrepancies. It maybe doesn't like some derogatories or some negative items on the credit, and it just doesn't render a decision. So we call that what we call a manual underwrite. And a lot of companies won't do it at all. We do a ton of them. I'm sure you guys do too. But basically, it's thinking outside of the box and saying, you know what, I'm not going to decline that client because this will work on a manual underwrite. We just need to submit all of the documentation we've discussed today and get the underwriter to basically put their name on the line and sign off on it. And the good loan officers know when and when not we can do that.
And an important thing to know with that, in general, the manual underwriting guidelines are more restrictive. The automated will let you push a little bit further. And most of the time, to get that manual approval under those more restrictive guys, we need some compensating factors. We have to have some strengths because there's something in the file that the automated doesn't like. We have to show the human who's going to approve it, yes, that's true, but here's why it's an acceptable risk to the lender.
Yeah, I totally agree with that. And that's what a manual underwrite is, right? So a lot of times the compensating factors can be, well, look how much time this person's been on the job, it's stability. We'll look at the credit over the last 2 years before the negative stuff, or after the negative stuff happened. It's been clean as a whistle for 2 years now. Or there's 2 months reserves, right? After closing, there's the first 2 months of payments are in the bank sitting there just waiting to make those payments. Those are type compensating factors, and you almost always need something strong to offset something negative. And that's how a manual underwrite gets successful. But like you say, Jason, I totally agree. We do them all the time, and it's perfectly capable of doing a manual underwrite. You don't have to go by automated underwriting, but you do have to give us something, help us out here. We got to show some compensating factor.
So we're closing in on an hour here. I've got one good last question that comes up here frequently. I'd love to run by you guys. So my loan's been approved. Does anyone else have to sign off on it? And there's kind of two instances where I see that this happens. It's a loan with less than 20% down, a conventional loan with less than 20% down. Sometimes, or most of the time, we have a mortgage insurance underwrite. Is that any different, or are we likely to have a mortgage insurance underwriter decline a loan that one of our underwriters says yes to? You guys have any thoughts on that?
I guess I'll go. So we do all of our own delegated MI. So if we sign off on it, they were good. I've heard of situations where you have another underwriter signing off on the insurance, the mortgage insurance. But I think one of the situations, not to get too off topic, but one of the other ones is the compliance review. I think today, 20% of all lenders have to do a compliance review. I think if you're selling to Fannie or Freddie or both, don't hold me to that exactly, but basically 1 out of 5 loans are randomly selected for us that say, hey, we're going to do a QC audit, a quality control audit. And they scrub everything the underwriter looked at to see if she missed anything, or if that background check or fraud check on the back end brings up anything that wasn't caught. So that's my only situation.
Once you've proven that you're mean and prickly enough as an underwriter, they move you to a QC underwriter so that you can then review the work of other underwriters and tell them how they failed. So 100% correct.
That's a whole level down in the basement. That's a sub basement.
Those people don't even want out of the basement. They enjoy it down there. The last one, or the time where we can see a requirement for a second underwrite, is some jumbo loans. Some of them just require a second signature, and that's just because it's generally a bigger loan, more risk, and some lenders, not all, want to see 2 underwriters putting their signatures to it. So we covered a lot of ground. It's a big topic. We literally could take some of these chunks and do an hour just on those. But before we jump off, anything that you guys think the viewers at home, the Find My Way Home viewers, should know about underwriting?
I guess I'll jump in first. It's not, I think we've covered a lot. Know that the underwriter has your best interest at heart, you being the home buyer. And a good underwriter really wants to see you get in that home, if at all possible, while at the same time making sure that you're going to be successful in home ownership, right? You've got the capacity to repay that loan and live in it long term and be happy and create a life in that new home. But I would say, just if you're on the fence and you want to, like, for example, I just closed a loan for a woman who's 60 years old, first home, and she was crying at the closing table. I almost never go to my closings anymore, but I went to this one because it was such a success. And she was weeping at the closing table for joy because she said, I never thought I could buy a home. So the thing I would toss out there is, if you're kind of on the fence of, can I ever buy a home? Can I not? What's it take? Call one of us. And if we're not licensed in your state, we'll put you in touch with one of the experts in our expert network for sure, because we can help you. And it may not happen today. It may take 6 months to get ready, but that's okay. 6 months is a lot less time than 60 years.
Yeah, that's perfect, Jim. And I think, Josh, I actually been working on my team for many years now, saying, don't say no. Maybe it's not now, but don't say no, right? And I think everyone on this network is super experienced. I really truly believe some of the best of the best. And I feel, I wouldn't say sorry, but it concerns me from a borrower standpoint, because they either were told yes by an incompetent person or told no by an incompetent person. So who do you believe? And it's a battle, but I think everyone on the network is someone you could trust. And hey, mistakes happen, but we're all experienced to know what and what cannot work. And if not, we're leaning on each other to figure that out as an experience level, versus some guys say, hey, let's go with the cheapest guy that's working in the cubicle, Josh, that doesn't have time to look at all of the things that the underwriter is going to need, because they're doing a volume game and trying to make a couple $100 a loan and do hundreds of them, and they have to move on. So
Yeah.
anyway, hopefully that helped.
No, absolutely. And I just want to leave everyone with the thought of, your loan officer is the editor of your story before it gets to the underwriter. Tell them everything. They're not asking things to be difficult. They're not asking things to make it hard on you. They're wanting to have as pretty a story as possible, so that file flies through underwriting with minimal conditions and you get the home you want with the best terms available. So again, guys, thank you for joining me. We've had a great conversation. I love being part of these every week. If you're watching at home, you have questions, we have answers. Reach out through findmywayhome.com. We have a directory there of experts throughout the country. You can find someone in your area who can help and can get you the answers that you need. So again, thanks for joining us, and we'll see you again next week.